Hello everyone and welcome to Module 3.8, Learn how to manage your finances. Getting to grips with the basics of financial management can seem daunting at first. However, it is one of the most vital aspects of running a business, particularly if your business is in the water or climate sector where budgets tend to be limited. Understanding finances can also help you make more informed decisions and convince potential investors that you can put investments into good use in a responsible way. In this video, we will start by looking at what liquidity planning is. Then we will learn about profit and loss statement. And finally, we will understand what a balance sheet is. Let's start with liquidity planning. Liquidity planning can spell the difference between success and failure. It's entirely possible for your project to earn a profit and still go out of business by running out of cash. Cash management involves forecasting, collecting, dispersing, investing, and planning for the cash. According to statistics, more projects and startups fail for a lack of cash rather than for a lack of profit. In order to have a good liquidity plan in place, you must first understand what a cash flow cycle is. As described here, a cash flow cycle is the time lag between paying suppliers for merchandise and material and receiving payments from your target groups for the services or products that you are offering. The longer your project cash flow cycle is, the more likely you are to encounter a cash crisis. You should generate or update a report showing the following aspects of your project: total cash on hand, bank balance, summary of the day's sales, summary of the day's cash receipts, summary of the day's cash disbursements, and a summary of your outstanding invoices. Try and look for ways to reduce your cash flow cycle length. You can achieve this by either reducing the time of your solution in inventory or by reducing the days in receivables. For example, by billing your target groups or end users promptly and offering them discounts for fast payments. Here are some basic points to consider when preparing your liquidity plan. Decide what your minimum cash balance is going to be. How much cash cushion should you have to cover unexpected costs, whether these are internal or external? Forecast sales. However, don't be too optimistic in projecting sales, since you never know what will happen in the market, so always be prepared. You should also forecast cash receipts. Account for the delay between the sales and the actual collection of the proceeds, since that could be quite big. Forecast cash disbursements. You should record in the month in which they will be paid, not when the obligation is incurred. And finally, determine the end of month cash balance. This means the cash on hand, the total cash receipts, and subtracting total cash disbursements. Let's move on to profit and loss statement. The profit and loss statement is used to compare the expenses of your project against its revenue over a certain period of time, to show you your project's net profit or loss. This is a simple example of how to calculate your net profit or loss. Start by recording all the income that flows into your project, whether that's sales revenues, rent, investments, interests, etc. Then subtract your project's various expenses, which could be things such as cost of sales, salaries, costs of marketing campaigns, and other expenses. You then have your total net profit or loss. Let's finally move on to balance sheet. The balance sheet provides a sort of snapshot of your project's financial position and provides you with an estimate of what it's worth on a specific given date. This is the basic structure of a balance sheet. Assets equals liabilities and equity. If you don't know what these words mean, don't worry, we will go into more detail in just a few seconds. So think of it as having two sections that show the assets that your project owns and the claims creditors and yourself as an owner have against those assets. The balance sheet provides you with a baseline from which you can measure all future changes and developments. Any increase or decrease on one side of the equation is offset by an increase or decrease on the other side. Assets show the total value of everything that your project owns. There are two types of assets, current assets and fixed assets. Current assets are cash and items that you need to convert into cash within 1 year. Fixed assets, on the other hand, are those acquired for long-term use in the project. Liabilities are payment duties that your company has. There are two types, current liabilities and long-term liabilities. Current liabilities are debts that you must pay within 1 year or within the normal operating cycle of your project, whichever is longer. Long-term liabilities are the ones that come to you after 1 year, such as a mortgage. And finally, if you're confused by everything that I've just told you, don't worry, it's completely normal as these things take a while to learn. Head over to the module fact sheet where we will explain financial management in more detail. Thank you.